So in order to answer the first question, which is basically our returns, so I need to go back in history and explain what is the health of our portfolio, the way we monitor it and the way we see it, and why do we not react just because we are down or just because we are up. Now, the graph on the left shows the cash flow growth of our ITUS portfolio since inception versus that of Nifty. Now, when I say the health of our portfolio is in the best shape ever, what we as analysts are looking at is our portfolios as they report on a quarterly basis, and we analyze that. It's not about revenue growth or PAT growth. How are they consolidating all of that into actual operating cash flows, which is what accrues into the balance sheet on a year-on-year basis. And as that grows at a healthy pace, that is what translates into shareholder IRR over time. So one of the attributes of our portfolio since inception and up until today, until September 2022, is the healthy nature of cash flows and how it has grown over time. And it has always been roughly around 8 to 12% higher than that of Nifty. And that is something which is a core input factor around how we construct portfolios. So in an ideal world, or rather in a theoretical world, we as shareholders or minority shareholders of companies should expect to make the cash flow growth that our portfolios give us. So what that means is depicted on this table on the right. So 1 rupee effectively invested in the fund theoretically should have given 23% at the end of year 1 or 24% at the end of year 2 and so on. Right? Because your cash flow growth, if I assume that in the ideal world just gives me a linear return, then this is what should happen. So 1 rupee should roughly be worth 3.59 rupees in a theoretical world, in a smooth world, but life in the equity markets never works that way. It always is non-linear, which is what the actual ITUS return is compared against. So as you can see, across periods, we've always had discrepancies between what the actual cash flow growth expectation is and what the return realization is. So 1 rupee is roughly worth 2.81 today. So when I say our portfolio is cheap or expensive, I'm benchmarking it against the portfolio health, which is the table on the left, and referencing, are we actually dealing with a portfolio which is deteriorating in quality, as a result of which we are underperforming, or is the portfolio cheap because the health is good, but the returns have not yet accrued? Today, as I speak, it's the latter, where the portfolio is actually in a healthy shape, but the returns have not yet accrued. Now, this table obviously does this over 1 year periods. Now, what I'm basically going to do is to slightly expand this period and say that I don't know when an investor comes into ITUS, and that is why we don't run model portfolios, but I'm going to make it independent of when an ITUS investor came and joined us. So out here, we are taking slightly longer periods of time, which is depicted in the table below, right? I'll take you through this table. So assume an investor came in ITUS in Jan 17. Theoretically, because of the way we constructed the portfolio, over 2 years, he should have made 52.52%. But actually, he's made 43.35%, and the difference is not significant, I would say, right? And I'll show you what significant is. Whereas the same investor, assume he had come in Jan 18, theoretically, he should, over 2 years, he should have made 54.75% because that's the cash flow growth of our portfolio. But he's ended up actually making 8.73%, and he's shocked, he's not happy. No investor is happy to make 8.73% cumulative after 2 years, right? But this normalizes. Where does the normalization happen? Look at what happened between Jan 19 and Jan 20. And the normalization actually happened in the Jan 20 to 22 period, right? Where theoretically he should have made only 51, but he's actually made 81.38. So this normalization does happen, but it takes some time to happen when you have underperformed your theoretical expectation. Same thing, now standing in Jan 21, an investor looking at the portfolio has made 19.45% versus an expectation of 56.13. So what I can say looking forward is this is what I define by our portfolio is cheap. And this is what I define by saying that our portfolio is healthy. Now, the same thing is defined over a slightly longer period. where the gap will narrow, but the gap will exist, right? So Jan 17, if an investor had invested with us over 3 years, theoretically he should have made 90.3, but really he ended up making 68.2. Same thing for an investor in Jan 18, who's invested at 87.2, but ends up making 52.6. And where did the normalization happen? Over this period, where he theoretically he should have made 52, but he ends up making 112, right? So obviously, I'm doing this analysis with the benefit of hindsight. So I don't know where normalization happens, because then that is me being a soothsayer. But what is in control of us as analysts is to ensure that the portfolio quality stays healthy. Because when we underperform, like in calendar year 22, we still can come out and basically say confidently that the health of the portfolio has not deteriorated, which means it's a matter of time before the performance that we anticipate at our portfolio level accrues to the actual performance you see as investors. So this is the first chart that I wanted to leave you with in terms of how have we seen historically our returns accrue. And when an investor asks us the question, I have not made returns in the last 1 year, when can I expect to make those returns? This from history should give you a better understanding of when you can.